got the privilege of introducing to you our keynote speaker for the Investment Forum, Dan Pickering. He's also the co-president of Tudor, Pickering, and Holt, which is a Houston-based energy investment merchant banking firm, close to 120 employees in their Houston, New York, and London offices. And prior to co-founding TPH with Bobby Tudor, Dan was an engineer, financial analyst with Arco, Alaska, a portfolio manager for Fidelity Investments, and head of research at Simmons & Company. He has a B.S. in Petroleum Engineering from the University of Missouri and an MBA from the University of Chicago. What we'll do here today is Dan will give his keynote speech, and then afterwards we'll have time for a short Q&A session from the audience. One tidbit on Dan, he's going to be making his third trek to Africa this summer. But I also found out he is an avid poker player, so I thought maybe that if you wanted to help Dan fund that trip to Africa, we can probably arrange a few table games this afternoon after the conference is over. So anyway, please join me in welcoming Dan Pickering.
Well, thank you to Ted and to Koga for the invitation to speak, and I will say that I've lost much more money playing poker than I've ever won, so I will not be hosting a poker game after this presentation. So as we load up here, I think, can we pull up the slides that say it's a whole new ball game? For the past 18 months, making talks like this hasn't been very much fun because if you think back 3, 4, 5 years ago, 80% of the activity in the United States was natural gas driven. And for those of you living in that cave eating nuts naked that Dave mentioned today at lunch, natural gas prices haven't been great. And it's been tough to talk about the industry without thinking about what's happening with natural gas. And what I'm excited about is that we do have something new to talk about. There's a lot of excitement in the oil business, and I think there's going to be a lot of interesting things happen in the next, call it 2, 3, 4, 5 years. And so I was incredibly impressed with Halliburton's zooming out from the conference center here in Denver and up and the global view, and all I have is a little oil well spurting off of a baseball diamond. But, it's a whole new ball game. So what does that mean? For those of you that don't know, I did grow up in Missouri. That's Stan Musial, so he's wearing a St. Louis Cardinals baseball cap. And it does feel like everything is in place for what feels like a pretty interesting next several innings of the energy game here. And I always start off my talks reminding people that we have to be very careful not to ignore the big picture. The big picture for us in the energy business is what are oil and gas prices doing. But as we learned painfully in 2008, it's what's going on with the economy. And we don't need the economy to be good. It just can't be bad. The energy business is tight enough. The supply-demand dynamics in oil are quite tight with a small amount of growth, but we can't handle a double dip in the economy. And after 7 or 8 straight down days in the stock market and debt ceiling issues and what's going on with Italy or Greece or whatever the flavor of the day is in Europe, we can't take our eye off the fact that economy is very important. So let's keep our eye on that. But in general, the dynamics in the oil business are quite strong. And I'll say that, I'll talk more about this as we go through. But in general, we look at relatively tight supply and demand. We're running a $90 to $100 long-term price deck. I do think that it's going to be tough for oil to really pop out to the upside simply because of demand issues. But oil dynamics are strong. Gas should not be worse. I mean, I think that's the best thing we can say about natural gas is at least it won't get worse from here. I think we're going to wallow around in a trough for a little while. But the most interesting thing, and Dave talked about unconventional resources at lunch, we think that this unconventional asset trend is indeed global and it is long-term. So Dave showed the timeline of developing the Barnett and other shale and tight gas resources, but we think that essentially we're sort of 7 years into something that's going to last 30 or 40 years, and so we have a lot of running room out in front of us, and it is no longer just a gas story, which is a domestic story right now. It's an oil story as well, which has clearly got more global implications. A lot of focus and attention paid to what's been happening on the consolidation front. Anytime you get consolidation, people are very interested. Is this the start of a trend? So BHP buying Petrohawk was the evolution of what we've seen. We've seen a ton of asset transactions, particularly as North America has become a growth industry. Again, lots of asset transactions, lots of joint ventures, a few corporate deals. We think that we'll see more. And the thing that when things are good, I always try to remind people of, this is a cyclical business, and so let's not get too excited. Let's keep our nose to the grindstone and pay attention to those cyclical factors that might jump up and bite us as we move forward. So red line is West Texas crude. Black line is Brent crude. If you go back to 2007 and 8, those lines overlapped. Today they've spread, and we have a difference between Brent and WTI of $22 a barrel this morning. Too much oil in the mid-continent. We're cushioning prices, but generally we think that WTI and Brent will come back together, but I think importantly, that futures curve is pretty robust for a fairly long period of time. I will tell you the futures curve, when oil prices are high, the futures are high. When oil prices are low, the futures are low. So it does move together, but in general, we think that 90 to 100 is this comfort zone where demand can grow and supply can grow. Neither will grow quickly, but the energy business makes a lot of money in this $90 to $100 a barrel range, and we think that barring an economic meltdown, that's kind of where we're going to be. One of the things that I opened with is natural gas has been 80% of activity. So the blue line here is rig count, natural gas. And the black line is oil-related rig count. This is onshore in the U.S. per Baker Hughes. And I would tell you that the Baker Hughes numbers probably are a little overstated to the gassy side because liquids-rich wells sometimes fall into that gas category. But what you'll note is, and I went back to 2004 for the slide because that's really when the Barnett Shale took off, and essentially we had a doubling of activity in natural gas rigs, and also a doubling in oil rigs, but 200 to 400 versus 800 to 1,600 or 800 to 1,500. Take a look at the global financial crisis. Rig count dives, and that's why we've got to be so careful about the macroeconomic picture. But then look at the recovery. What happened during the 2004 to 2008 run-up was that all those rigs drilling for natural gas found a lot of stuff, right? And it wasn't just rig count went up. It was the number of wells drilled per rig went up, and the production per well went up. And so we had a doubling of rig count. We had clearly a more significant growth in supply. And so we come out of the financial crisis, and what do we have? A lot of natural gas. What we don't have is a lot of oil. But what happened in this time period is we found prospectivity. We discovered opportunity in oil. We had a lot of opportunity in gas, right? Lots of places to drill gas wells, lots of locations for gas wells. Not so much in oil until this unconventional resource started to be developed, application of horizontal drilling, fracturing, et cetera. And so if we look today, we have actually more oil wells being drilled or rigs drilling for oil than we do natural gas, and that's the first time in a very, very long time. Will this continue? Absolutely. Dave Lazar said I'm not going to give you a lesson in well economics. I will throw out some well economics, and here what I'm showing you is the IRR of a Barnett well is about 14%, and a Bakken well is about 48%. And so guess what is getting drilled more? The Haynesville is 26%. Sprayberry is closer to 30%. So oil wells make more money. Energy people are smart. They're drilling more oil wells. And I think that trend will continue. When we look at natural gas, again, I think the best thing to say is that it probably doesn't get a lot worse than where we're at today. We obviously had the big run-up with crude in 2008, too much supply, oversupply. We found equilibrium. That equilibrium is switching point. We always used to talk about switching between oil and gas. Now it's between gas and coal. A lot of incremental demand for natural gas comes on when it gets down to about $4 and we can switch from coal power to gas power. So 4 is probably our floor. Unfortunately, I think given the drilling that we're doing for natural gas, plus all the associated gas that's coming, right? It's not just a gas well or an oil well, it's gas and oil wells, or oil and gas wells. And so all of the associated gas that we're getting from these various liquids plays is clearly keeping supply high. And so we're watching rig count. That's the thing that will fix the gas story. LNG exports are at a minimum 3 or 4 years away. We're not going to drive natural gas cars anytime soon, or at least soon enough to fix the issues that we have in natural gas. And so it's going to be supply driven in the intermediate term, and supply's got to continue to trend down. And so we think that $4 or $5 is the range for the next 18 months. We've got a $6 number long term, which is the bright spot, and I'll explain why. I used to have a slide here that showed all these basins and the marginal costs in these basins, and everybody told me it was too complicated. I love that chart. The engineer in me said, this is just so brilliant. Now I have a pie chart. This pie chart is essentially what we did was we looked at all the basins in the U.S. and how much production came from those basins. And then we looked at the break-even economics associated with drilling a well and getting a 10% rate of return. And so essentially the way that breaks down is about 30% of production comes from basins that you can make money drilling under $5 an MCF. About 60% is somewhere between $5 and $6.50, and then 10% of production comes from areas where you need at least $6.50 or higher. So the way I tend to think about it simplistically, and this is an easy discussion to have when gas prices are low, is that you don't price a commodity on the cheapest third of supply, right? Not nearly enough of the industry makes money under $5. Everybody makes money sort of over $6.50 at this point, given all of the new plays that have developed. So essentially, production is going to come from areas that are profitable somewhere in this $6 or slightly less, and that's what we're using for equilibrium pricing. How long does it take us to get there? Well, it's not 2012. Hopefully, it's 2013. And so generally, we think about a $5.50, $6 number as where price is going to settle out long term. And that's generally what you see big companies paying for reserves in some of these transactions. Speaking of transactions, if we look back, the top of the last cycle was Conoco buying Burlington, literally within 3 days of the top in natural gas prices. This time around, Exxon buys XTO a few years ago. What was that telling us? That was telling us that it was getting tougher to grow outside the U.S., that shale and unconventional resources were for real, and that being involved in North America was something that was interesting and worthwhile. And from that period of time, tons of asset purchases, a huge amount of joint ventures, this technology transfer, the Norwegians, the Europeans, the Asians, very interested in understanding how to develop tight rocks. We've actually seen, because of what's happening in North America, we're actually seeing deconsolidation as well. Conoco is going to spin off their E&P business, separate it from the refining business, as is Marathon. So we've got all sorts of people really trying to attack the North American business. And here comes BHP and buys Petrohawk. That's happening in an environment where money is very cheap, oil prices are good, and gas shouldn't get worse. So our view would be if the world wasn't so kind of scary right now, we would see a lot more consolidation, big guys buying smaller guys, medium-sized guys buying each other. When the macro clouds lift, I think you'll see a lot more of it. So, what would I leave you with before our panel tells you what's really going on? And that is that North America has been kind of a gassy growth place to be, and now we can take off the adjective or adverb, whatever gassy is. Now it is just a growth place to be. We have a lot going on in North America. I encourage everyone to remember that supply, both on the upside and the downside, does react to price. And so whether it's the price of services that are going up, we're going to get more capacity in the oilfield service business. Whether it's the price of gas that's going down, we're going to have less supply of natural gas over the next few years. We are going to produce more oil in the U.S. Why? Because prices are high. You look to Washington and you shake your head, and you should. There's not going to be much from an energy policy perspective. It is going to be all economy all the time for the next 18 months, the election, et cetera. You know, status quo would be okay. Leave us alone, let us do our thing, I think would be a fairly decent outcome. I do think that the industry's too profitable to be ignored, and so I would expect revenue generation from Washington being focused on taxing oil companies, and you heard that in Obama's speech the other day. Macro, macro, macro. That is the fallback thing that I'm going to worry about, because I feel pretty good about just about everything in the oil patch. The one thing I can't predict is the thing I'm therefore watching the closest. And then finally, the way I think about this is an industry where we're used to cyclical highs and cyclical lows. It's great just in time to be bad. Well, I think that things are pretty good now. The next steps are for it to get better before it gets worse, and that is a much more fun message to deliver than the one I've been delivering for the last 18 months. So boom before bust. Thank you for your attention. I think I've got about 5 minutes for questions before we go to Q&A. So if anybody's got any questions, I think we've got mics that we can use, or if no one wants to ask a question, you can always trust the moderator to ask a question.
Hey, Dan, good afternoon. Bill Holland with Platts. CEO of Chesapeake Energy says that this industry can produce 4 million more barrels of oil by 2020. Is that just Aubrey being Aubrey, or can he legitimately push that claim?
That's a big number. The one thing we've seen, so let's use gas as an analogy. What we've seen in natural gas is that the industry not only did what they said they were going to do, they did about twice as much as they said they were going to do, and about twice as fast, which made price twice as bad. In oil, you've got a little bit of cushion in that it's a global business, and I think that if the U.S. could produce 4 million more barrels and push 4 million barrels out of imports and back out into the global market would absorb it. That number seems high to me. That would be, 4 on top of 6. That's a pretty big growth number. 2 seems like a no-brainer. So I'm going to say that sounds a little bit high, but I would have said the same thing about gas production forecasts from unconventional resources and been very wrong. So sounds a little high, but if I'm biasing my 2, I'm biasing it up, not down. Price tanks, all bets are off, right? It's very price sensitive. Other questions? Sure. The question was service capacity and where is that going? There's a fair amount of shortages now. I am a little cynical here. I think if prices are high, margins are very high for service companies right now. We've historically seen, and I think we will see again, as long as prices and margins are high and the forward outlook is good, all those things exist right now, that the oil service industry will add capacity, and they will add capacity aggressively. The trick right now is that we have a whole new thing going on, which is drilling for oil in tight rocks, and that's an exponential use of services. It is more frac stages, it is more time on job site, it is more chemicals, et cetera, required. So I tend to think that the service business will be tight for the rest of this year. I think that certain areas will start to loosen up next year. Loosen up does not imply historically the business 30% operating margins minus 10, back to 30, minus 10. I think we're going to wind up with service company profitability in the comfortable range. I think that we'll see well costs come down. I think we've seen well efficiencies come up already. And net, barring a problem with commodity price, I think that we might actually get a year or two, 18 months, where the industry is actually fairly in balance. Today we're out of balance. We're headed back toward balance. That will not happen fast unless commodity price really evaporates. So tight for a while, but probably getting a little looser by the end of next year.
Hi, Dan. Jeff Vaughn with Tracker Resource Development.
Hello, Jeff.
Hi. Can you talk a little bit more about the Brent WTI spread? You showed it taking a couple years to get close, but still not coming to parity.
You bet. So that spread is actually, that's the NYMEX futures and the, whatever the equivalent, Brent futures. So that's not my chart, it's what the market says it will be. What do we have going on? Brent is being traded by folks who are looking at global supply and thinking about what's happening in the Middle East, et cetera. So we've had a bit of a risk premium put into the price of global crude, a la Brent, and at the same time you've had oversupply come into Cushing. Bakken crude from Canada. Historically what happens is that Cushing crude then makes its way to the Gulf Coast to the refineries. Right now that capacity is full and bottlenecked. You're training crude to the Gulf Coast. You are trucking crude to the Gulf Coast. And that $20 a barrel is being captured by refiners on the Gulf Coast. That's a big spread. It typically doesn't last this long. And so we think that it'll probably tighten a little bit quicker. But until you can get more barrels out of the Mid-Con, it will stay wide. There are some that are forecasting this big super spike where we're flooded with crude in the Mid-Con, and that differential that's 20 now goes to 40. I think that we're more likely to see this 10 to 20 for the next year. And again, the industry, both the midstream side of it and the producers, if you're selling crude into Cushing, you are looking for any way that you can to get it somewhere else. Take it west, take it south, do something. And so we think that ARB is getting attacked, lots of little decisions every day. And so we think by 2013 it will be a much smaller number. So we're a little more optimistic about WTI prices relative to Brent in the 2013 time period. All right, thank you guys very much. I appreciate it. We're going to start the panel.
Well, thanks, Dan. Appreciate that. I'm going to moderate the panel on the service and the drilling side of the industry, so I made note of that comment that you made about high margins. So I'll be talking a little more about that later. So anyway, our second panel discussion on unconventional oil will be moderated today by Jim Klechner. He's the Vice President of Operations for Anadarko Petroleum. Jim oversees the Rocky Mountain region here in Denver for Anadarko, serves on both of COGA and Western Energy Alliance boards, along with the Industry Advisory Board at Colorado School of Mines. He's a graduate of the Colorado School of Mines. He's also a great golfer and an awesome skier. And with that, please welcome Jim Klechner.